Hello and welcome to Moneylife News and Views. I'm Debashis Basu. India's stock market is quite resilient. Since COVID-19 pandemic trough, the Sensex or Nifty have repeatedly scaled new highs buoyed by domestic inflows, a swelling army of retail investors, and a compelling narrative of long-term growth. Yet, as the indices recently edged past their records, a curious disquiet has set in. Many investors found their portfolios stubbornly in the red. Social media buzzed with perplexity. How could markets be at an all-time high while portfolios languished? There are vexing questions around the disconnect between Nifty returns and portfolio returns, between economic growth and earnings growth, and finally between earnings growth and market returns, and the divergence between these three sets. Let's take them one by one. First, Nifty returns versus portfolio returns. The Nifty is a club of giants, mega companies in banks, finance, software firms, pharmaceuticals, consumer staples, and commodity producers. These are mature, relatively stable businesses. They were never the principal beneficiaries of recent investment frenzy. The great bull run of 2023 and 2024 was driven instead by small and medium-sized firms riding a wave of government capital expenditure on railways, roads, urban transport, defense, water power, and green energy. Those companies soared and retail portfolios rose with them. Since early 2024, however, this massive government spending has slowed. It was first blamed on general elections, then on monsoon, and later geopolitical issues took the center stage, which is Trump tariffs to tensions with Pakistan, before the monsoon was blamed once again. Hundreds of companies that had been flying high on government capex have since stagnated or fallen. These are the stocks that dominate retail portfolios. The Nifty, by contrast, barely noticed this and was unaffected. With the exception of Larsen & Toubro, few Nifty heavyweights are direct capex plays. Having risen less during the boom, they corrected less during the slowdown. Comparing the Nifty with a retail portfolio, then, is to mistake apples for oranges. The second set of confusion: economy versus earnings. Now, this puzzle is a divergence between India's nominal gross domestic product growth and Nifty earnings. People just assume that the two are connected. If the economy is growing, so should Nifty companies and so should the portfolios of the retail investors. But there is a disconnect. India's GDP growth has grown at a compounded annual rate of about 10% since 2008. The common belief is that Nifty companies should grow their sales and earnings faster than GDP because these firms are among the country's largest, benefiting from economies of scale and market dominance. Yet, a recently released study by Motilal Oswal shows that Nifty earnings per share grew at a CAGR of just 8% between 2008 and 2025. Why the disconnect? For starters, the connection between GDP growth and and earnings growth was first imported from the United States, where around 70% of GDP comes from consumption, and most of that consumption flows into listed companies as sales. In India, consumption accounts for roughly 62% of GDP, and a much smaller share flows into listed consumer companies. Capital expenditure further weakens the link. GDP is boosted by investment booms that barely touch Nifty firms. India has experienced this twice in the past 2 decades. The first was in the period before and after the global financial crisis. Under two Congress-led regimes, there was a capex boom, but hardly any Nifty companies benefited. Indeed, much of it involved large-scale plunder by crony capitalists and bankers. The second boom was government-led capex between 2022 and 2024, which directly benefited smaller companies but not Nifty constituents, as I have noted earlier. GDP growth and corporate earnings can diverge for other reasons as well. One is playing out in China, which has relied on ferocious internal competition to build immense manufacturing capacity. This has benefited the citizens, the consumer, and the country, but not its companies, many of which operate on wafer-thin margins. That is why China's stock market scarcely reflects its impressive economic growth. For China, other Asian economies, South Korea, Taiwan, and Japan experienced periods of rapid growth in the latter half of the 20th century, the country as a whole, and yet earnings growth failed to keep pace. Now, the third set of dilemma, which is earnings versus market returns. The third belief is that higher earnings growth will automatically translate into higher market returns. This is the most dangerous of the three because it assumes that starting and ending valuations do not matter, only earnings do. If starting valuations are low and exit valuations are high, returns will be strong, irrespective of modest earnings growth. At the depth of the bear market in October 2008, Nifty stood at around 2,500. By early 2020, it had climbed to roughly 12,000, an annualized return of 15 to 16%, excluding dividends, despite earnings growth of just 7% during that period. The reverse is equally true. Starting at high valuations and exiting at lower ones leads to wealth destruction. Taiwan recorded GDP growth of over 5% a year between 1990 and 2008, yet its stock market fell by almost 50% over the same period, undone by valuation compression. Japan's Nikkei delivered negative returns for 34 years from the 1989 peak. The past 3 decades have been punctuated by recurring enthusiasm in India about structural change, new missions, policies, and grand projects. For all the exuberance surrounding India's stock market and economy, the ultimate outcome for investors has been rather pedestrian. The chief culprit is poor earnings growth, a variable that no amount of storytelling can obscure. Corporate profits, once expected to sprint on the back of reforms, consolidation, and formalization, have instead only trudged ahead. That leaves only one other lever to boost returns, which is low valuations. Yet, even the bulls concede that valuations are not low today. The math is unforgiving. Without stronger profits or cheaper prices, storytelling fails. Will investors update their beliefs? If you like this, please to share and please to subscribe to the channel. Thanks for watching.